All right, let's turn now to the state of the U.S. economy and a bit more on what we heard from Fed Chair Jay Powell yesterday afternoon. I want to bring in Seth Carpenter. He is the chief U.S. economist over at UBS for more on this. So, Seth, let's just start with what we heard from the Fed yesterday and your overall take on whether, if at all, it reframes your expectations for how Powell will proceed through the rest of this year and really through the end of next year.
Yeah, no, that's a great question. And it doesn't reframe things too much relative to my expectations. If anything, I was expecting him to have a little bit more courage of his own convictions and commit to something longer term. And you look at the dot plot, only 2 of the 17 think that they're going to raise interest rates by the end of 2022. Clearly, there's uncertainty. Clearly, no one knows exactly what's going on. And I suspect what happened was that jobs report caused all the people who were sort of reluctant to commit to anything longer term to go, wait, we can't do anything now. Let's wait for a little while longer. But Powell in the press conference was very, very dovish, very, very clear that it's going to be a long, hard road digging out from this pit. And he seemed ready to sort of wait, be patient. They don't think inflation's a problem. It's not going to be a problem for a long time. Their forecasts see inflation falling well short of their target even 2 years from now with super accommodative monetary policy and fiscal policy. So no, I think it sort of reinforced what had been my view before, which is that Powell is ready to just hunker down and do everything he can to support the economy.
Hey, Seth, it's Shauna. I know something that you were watching yesterday going into the decision and into the Q&A was the yield curve control. And when he was asked about it, Powell said that it's still an open question. So I'm just curious at how you're interpreting his comments. And then what do you think would warrant the Fed to turn to the yield curve control in the coming months or so?
Yeah, that's so funny that he said that and that some of the other reports are that they're still considering it. I mean, I think the point for them right now for front-end yield curve control is to reinforce that commitment that we're staying lower for longer. All the Fed research points out that that's their view of the best substitute for negative rates because they don't want to do negative rates. I find it slightly surprising that they would say they need to study it more because you can go on the Fed's website and find a memo from way back in like 2012. So 8 years ago, where already staff were working on sort of explaining to policymakers how this could work, the pros and cons, blah, 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 blah. Lael Brainerd, governor of the Board of Governors, gave a very, very, very good, clear, crisp, articulated discussion in February this year explaining how it could be worked. And so I suspect it's still under consideration is actually code for there are a bunch of people who are holdouts and Powell would like to see a little bit more consensus before moving forward.
And, Seth, I guess related to yield curve control is that language they had in the statement about, asset purchases at least this level. And I guess, to me, a yield curve control program is like an innovation of sorts, I guess, on QE. It does sound like they are laying the groundwork, though, to be more active, maybe more creative with how they use their balance sheet. Is that something you see as well?
Yeah, no, I think that's right. And so I was actually expecting them to put a little bit more structure to define their asset purchase program and then sort of be willing to go for a slightly longer period of time, but maybe at a slightly lower pace. The fact that they came in and said at least the current level of purchases for the next several months says, okay, it's going to be this 80 billion of treasuries, 40 billion of MBS for at least the next 3, maybe 6 months. And so that was actually a pretty aggressive lean. I think Powell really is trying to sort of dot I's, cross T's, or slightly less generously herd some cats so that they can come out with a package that is clear, internally consistent, and really sort of shows the market and the economy and everybody involved. The Fed is really there to support the economy.
Seth, when you take a look at the market's moves today, obviously it seems like investors for the first time before today, they have been ignoring the prospect of any more shutdowns related to coronavirus or the fact that we're seeing this rise in number of cases in certain states. So I'm just curious as to how you're reading that and how you're incorporating the most recent data that we've gotten over the last couple of days into your economic forecast here going forward.
Yeah, so I mean, I think, again, like everybody, there's huge uncertainty. And so you have to think about this in a whole set of scenarios and try to figure out where the probability goes. The jobs report was a massive shock to my profession. So no one particularly shrouded themselves in glory. But I think it did two different things. And then the subsequent data that you're talking about, COVID cases and hospitalization, bear it out, which is states that are easing their mobility restrictions are seeing businesses open up, and you're seeing a reflow of hiring. And so on the one hand, that makes you go, okay, we're going to get potentially a slightly faster rebound than we anticipated. People are going to get hired back. On the other hand, as the COVID cases show, lowering those mobility restrictions and opening up the economy, as good as they might be from an employment perspective, also bring with them this higher probability of some substantial second wave. It's too soon to know for sure whether or not that's going to happen, but the probability on those two scenarios, which are both different from my baseline, the faster snapback, but also the second wave, those have increased. And so if anything, it just makes things slightly more murky as opposed to giving you any sort of extra clarity.
All right. Seth Carpenter is the chief U.S. economist at UBS. Always great to get your thoughts. Thanks so much for calling in. Hopefully we could talk soon.
Thank you.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.